Hi, it's Connie from Prosperity Finance. I hope you're doing well, and thank you for being here. Today, I'm going to share with you a real application that we did for a young couple. Now, the reason I want to share this is because a client came to us for upgrade home finance. Now, client has a good income and equity in deposits, so it's actually a very straightforward, simple transaction. However, we add lots of value to that. And I thought if I share this, and if you are in a similar situation, you might get benefit from this as well. So let's have a look what happened. Now, this is a real case, as I mentioned. However, for privacy reason, I use fake names. Let's say the couple, Eric and Sarah. Eric and Sarah are a married couple. Eric is IT professional. He's on 100K salary. Sarah just got a degree in early childhood education, and she recently got a new job from a daycare center. Now, Eric used to have a family home living in. And after meeting Sarah, they decide to upgrade home and get into a better suburb, better location for their family. So Eric doesn't want to sell their current property. The property is currently, market value is around 680K. And Eric owe BNZ 400K. They saw a property they really like and they want to buy. They finally negotiate the price for 1.1. They have 200K from their own savings and family gifting, so they only need to borrow 900K. Now, with the total loan amount of 1.3, which is the existing 400K plus 900K new lending, it should be no problem, given Eric's and Sarah's income and equity deposits. However, in this case, I saw Eric, if he just applied 900K on top of existing loan without any restructure, he probably not get the benefits of restructure. Why I say that, I thought I'd use example to illustrate so that it help me to explain. So here I'm going to share with you a file. So in this case, the property that they currently own and they're looking to rent it out, they can rent it for $540 a week. Now, the total rental income per year is going to be $28,000. Now, for this kind of investment property business, they are going to have some fixed cost. So let's say insurance 1,000 and council rates plus water fixed charge about 2,700, and we also allow $500 for maintenance repayments. So the total cost about 4,200. Now that leaves profit before interest and tax about 24,000. So that means if they don't have any loans, therefore there's no interest, then they need to pay income tax on the $23,880. However, they do have a loan. As I mentioned earlier, Eric owe BNZ 400K. So there will be some interest cost. But how much interest cost can be deducted so that they can minimize the profit, so that they minimize the tax obligation? Now, let's firstly do a quick break-even analysis. So how it worked out is, let's say a client doesn't want to pay any tax, therefore the interest cost needs to be $23,880. Now, let's use the current one-year rates, 2.39%. So in order to cost them that amount of interest, then the minimum loan would be around $1 million, okay? But the clients only have 400K loan. So that means definitely have to pay tax on the profit, right? But the closer to this number, the better. That means, less profit to pay tax on. Now, the maximum loan actually they can borrow is actually the market value, which is 680K. So even though this number is still lower than the break-even loan amount, but hey, it's still better than the 400K, right? Because they can borrow extra to 80K. Therefore, they can generate additional interest costs of $6,692. Now, remember, Eric is on high income. He's on 100K. So his tax rates, any additional income he has to pay 33% tax on it. So that means every year, Eric need to pay $2,200 every year if they don't restructure, right? So that's a huge cost. Let's say over 10 years, that's going to be, 22,000, right? So that's quite significant. Now, if some situation that loan is lower and the market value is higher, that saving could be much more. So we see the trigger that the clients need to see a good accountant, a tax accountant, to get professional advice to see how they can restructure this property so that we can get a benefit of borrow more for the purpose of that rental property. So in the end, clients came back to us and say, I've got the advice. So my accountant asked me to sell the current property, the rental property, into an LTC company. And then we sell that property at the market value of 680K. Okay, so then we use the sale proceeds to buy the home. So this is how we structure the loan. So the LTC going to have a sale purchase agreement to purchase this rental property at 680K, which is the market value. Now, we use the bank A to borrow 80%. This is, at the time, some banks still allow 80% of borrowing for investment property. So 80% of the purchase price, 680K, is 544K. Now, the remaining loan, we're going to borrow from a different bank, let's say Bank B. So that make up 680K loan. Right. Now, Eric received a sale proceeds from selling the old property at 680K, and he needs to repay BNZ 400K, so that he got 280K as cash. Okay. Now, Eric and Sarah are going to buy a new home for 1.1 mil. Part of the transaction settlements is they're going to use the 280K sale proceeds of selling the old home. And they also have the family gifting and their savings about 200K. Therefore, they have 480K cash. They only need to borrow 620K from the bank, also from Bank B. That's for the purpose of buying new family home. So the final loan structure is client borrow 544K under the LTC, which is 80%. And that loan is going to be interest only for 5 years. Now, they approach Bank B through us, have 130K, which is the remaining of the purchase, still under LTC. And then they also borrow 620K under their joint names. It should be joint names here. And the security they're going to offer is their new family home. The loan-to-value ratio, LVR, is less than 70%. And this part of a loan, because it's for family home purpose, we structure as principal and interest only. Principal and the interest, and the 136K is the interest only. Okay, so the total loan is still 1.3 mil. Now, compared to without restructure loan structure, our client has a 400K existing loan with BNZ, and they're going to borrow 900K, so that's also 1.3. But then we reallocate the loan so that the 680K all for the purchase of existing home, which is a future rental, and only 620K is for buying new family home. So that way we can say, actually, there are 680K loan against that rental property. So all the interest costs that generate from the 680K can be treated as interest expense to lower the profit here. Now, the benefit of this structure. Now, number one, obviously, we help the client to save over $2,000 a year by having this restructure of old home. Also, as you can see, we actually split the total loan, the 1.3 mil, across two different banks, and we only provide one property as security to one bank. So the other bank has no control over the other bank's security. So that gives clients maximum asset protection. And also, remember, we structure the investment property loan as interest only. So that way, the interest cost will be maxed out. Therefore, the profit is minimized. Therefore, the tax is minimized. And at the same time, because client has more cash, because they don't pay principal on the rental, they have more cash to pay off their family home. So the family home can be paid off faster. Now, in terms of bank we used, for Bank A, we used ANZ at the time because, number one, ANZ has good serviceability, so they can lend that amount. But also ANZ has 80% LVR against investment property so that we can max out client equity level. Now, for Bank B, we use Westpac in this case because Westpac has a really good product so that when you fast track your home loan repayments, it doesn't necessarily reduce the long term. Therefore, it doesn't really have an impact for future borrowing capacity. Compared to some other banks, if you pay faster against your family home loan, then it automatically reduces the long term. Therefore, if you need to borrow more later on, you actually reduce your borrowing capacity because you're paying faster on the existing loan. Whereas Westpac, they treat repayment of the existing loan separate from the long term so that you can have the best of the both worlds. You can pay faster and at the same time you don't compromise the future borrowing capacity. So there's quite a few benefits that come out of this restructure. So we thought it's really important that we share with you so that if you are looking to upgrade home in the near future and you're not going to sell your current home, you want to keep a full loan long term, this structure might benefit you as well. I hope this, you find this helpful. Obviously, everyone is different. The principle is the same, but if you are in a similar situation, we recommend that you get in touch with us and we provide a tailored structure for you. Right. Thank you so much for watching today. I will see you next week. Bye for now.